Traderade family, welcome to this episode of Navigating the Markets for the week of April 17th, 2023. But before we look at the week ahead, let's look at what's just happened. First, we can see that personal spending on services is beginning to fall. This is a good sign. It's showing us that inflation is decelerating on the services side, which was key for the Fed. So we're seeing some progress in areas we really need to see it. This is an encouraging sign, but we also have to remember the implications of this is a slowing economy and some compression in earnings. Services make up about 77% of the American economy, so most companies that do business here are services companies. When that year-over-year change of services inflation begins to peak and slowly recede, that will translate to lower top line for some of these same services companies. We can also see that sticky inflation is rolling over, and this is an encouraging sign. This is showing us that some of the inflation that tends to take a longer time, hence the name, is beginning to decelerate. It doesn't mean that prices are going lower yet. We would actually need to see this number give us a negative reading, which it hasn't really ever on this entire chart here, even during the great financial crisis. But at the very least, it seems to be peaking. This is something we're going to continue to watch here, as this is key for the Fed's battle against inflation and also for the economy overall. Last week in the market, the Dow Jones Industrial Average was up 1.2%. The NASDAQ only eked out 0.3%, with the S&P coming in right in the middle at 0.8%. But what really had my attention was the divergence between oil and bonds. Highlighted on screen, oil over the last week was up 2.4%. Bonds were down 1%. Now, year to date, they're almost break even. Oil up 3% year to date, bonds up 3.7% year to date. Of course, the NASDAQ is the winner, up 15.8% year to date. But we're starting to see oil come back from its lows that it registered in late March when it was trading around $65 a barrel. It's been as high as 83 and change when I was looking at it. It's traded off just a little bit from there, but this is a situation that is dynamic. This is a very volatile commodity. The OPEC cuts help to add some of the upside pricing. That doesn't mean that this is a new normal in pricing. Eventually, a slowing economy will pull down the price of oil. But for now, we're at least seeing some buoyancy. That's lent some of a tailwind to the energy sector, to the commodity. This is something we've been talking about on some of these videos as well as on our Discord, because oil has been a very interesting sector. When it was in the mid 60s, people were positioned for it to go to the 50s. There was an extreme amount of short interest in the commodity, and then there was very low net exposure to energy companies. And when you see that sort of activity in such a tight supply demand dynamic before we've really gotten into the recessionary environment, it usually gives us some cause to believe there could be a pop. And then of course OPEC came in with that cut that really, if you think about it, these economies, as Aisha's covered, they need to be $75 a barrel or higher, really, for their budgets to work. Russia's even about $100 a barrel. So in any case, they need to see oil at much higher prices. And without that, they start to run into deficits. They start to run into more difficult economic issues, the potential for austerity or borrowing money. So they made that strategic decision for in the here and now to front load higher oil prices so they could at least raise some money while the getting was good. The problem with this is, of course, this creates more potential for goods inflation. There's a very strong correlation between the price of oil and CPI. So we're going to be keeping an eye on this. If oil prices stay high and it starts to push through other parts of the economy, it's likely to create some more sort of stumbling blocks on the way down to lower inflation. For now, at least, inflation peaked last year. We've seen deceleration. We've seen some degree of disinflation. But remember, this is a bit precarious because a lot of the inputs, the structural supply side dynamics haven't been resolved. It's just that we've seen some weaker demand help to offset. And there has been normalization in the supply chain. We have seen some improvement there. But remember, wages remain high, and so do a lot of the costs for running businesses. And then the cost of capital is going up, and that can also introduce inflation in the form of higher costs need to be passed on, and it reduces supply side elasticity as there's less likely exploration for minerals, for mining, for energy, and less likely production for the same, as well as farming. And basically that has an impact of, as we see demand normalize, there's not enough supply. So those are dynamics to keep in mind, that really raising rates has its own impacts on potentially exacerbating inflation in the future. On the other side, we can see bonds were down, and it makes sense, right? Some of the fear trade is coming off. We saw a lot of weakness in gold. We'll talk a little bit about that. But on Friday, it was really coming down pretty well. And I think that the bond trade coming off the way it did on the week is similar. Some of that flight to safety is coming off, some more bull spirits, animal spirits in the commodity sector. The sort of growth trade is coming back on a little bit. The recession trade is coming off a little bit. And that explains some of this price action, as well as the relative weakness of the NASDAQ versus the Dow Jones. And one of the trades that we talked about was long Dow, short NASDAQ. We can see on the week that's been a good trade to be long the Dow and short the NASDAQ. And even in the futures trading session tonight, that trade continues to work. And it has everything to do with blue chips being more safe, the NASDAQ being higher beta, longer duration. In this environment, the Dow is more likely to do well than the NASDAQ. But of course, this could all change as we go into earnings season. And we can see the FinViz heat map from last week. We saw a lot of strength in financials. Of course, JP Morgan's earnings were great. That helped to propel the market higher. Citigroup had decent earnings. Wells Fargo was passable. This gave a lot of buoyancy to the financial sector. We also saw some weakness and flatness in tech overall. It has, of course, been leading, but last week we saw Intel down close to 3%, Microsoft close to 2%. We also saw some weakness last week in consumer defensives like Target, Walmart. They were actually down on the week. We saw some strength in energy. Chevron was up close to 3%. There was also some strength in the industrials and the restaurants. In utilities, we saw some selling, and healthcare was a mixed picture with a decent amount of green, some flat, and some red. So this was a mixed week. It was not a lot of upside participation in terms of breadth inside the S&P 500. Some of the defensive sectors were actually seeing some distribution, as were some of the riskier sectors like tech. It was interesting overall, but the cyclicals seemed to lead the week. When we look at financials, industrials, energy, basic materials, there were some animal spirits bullishly allocating into those sectors. We also see liquidity is coming back into S&P futures, and this is great news for traders. Whether you're a swing trader or a day trader, it's much easier to get better price discovery and order fills when the book depth is higher. And we're getting back to more normalized levels of liquidity after it pretty much disappeared for a period of time in March, and not just in the S&P, but in the bond market. And that was eerie. You don't want to see liquidity just run out of the market. It makes it more likely to have wild swings. So having that liquidity come back as a bit of a cushion, it helps to mitigate the chance of really wild swings and days where there's just no bid or no ask. You can have the market crash up or down. That's something the horse has talked about a lot, in the fact that the market can crash upwards too. And we've certainly seen that. And this helps to buffer that. That and the fact that, at least for now, we're in a positive gamma environment, and that's likely to compress some volatility as well. Speaking of options, we are going into options expiration next week. Do expect there to be greater volatility, particularly as we get to the end of the week. We are going to have some of those Vanna and Charm flows adding to the bid in the morning and the afternoon during our cash session, 9:30 to 4. That is going to be something that's most pronounced really in the first hour of trade and the last hour of trade. And so keep an eye. Those flows are likely to be a bit more supportive, and they'll be stronger as we get closer to options expiration. So really next week, Monday, Tuesday, Wednesday, Thursday, those flows are pretty strong, and it's something to keep an eye on when you're trading in the morning and the afternoon, because if you're short the market, it can work against you. If you're long the market, you need to be careful of your timing for those day trades based on how those flows might bid up the market, and then we might see a little bit of weakness after they're done. We can see based on spot gamma here that the hero chart is showing calls well in excess of puts. In fact, puts were being sold as calls were being bought. And I think that's a concern. This was from Thursday, but this is a noteworthy extreme because this kind of sets us up for a situation eventually, if there's some normalization, of this going the other way. And at the very least, we're seeing some potential for normalization of this trend. So going into options expiration with so much call participation, just be careful. We're going to see some of those magnetic forces of big open interest positioning come back in and start to have a greater effect. 4,000 and 4,100 on SPX are very key levels to keep a close eye on. And if we look at the modeled S&P 500 return based solely on liquidity adjusted investment flows, this chart from John Marshall at Goldman Sachs suggests the S&P should be trading a bit lower. This 4150 level that we're sort of hovering below right now, that's a big area of open interest and exposure. It's acted as a magnet, but also as a bit of a ceiling. We've had a head fake above it, but we haven't been able to really close above it. I would be watching that level as an area of resistance going into this week. Obviously, if we get above it, 4,200 is right there. And it's very achievable for the bulls. But if we do start to push below it, watch 4,100 and watch 4050 and 4,000. These 50 levels are where a lot of the options exposure is, and 4,000, 4,100 are huge levels. As a Traderade member, you can always check the ongoing dynamics by going to the members section and looking at the SPX gamma charts. And there's a whole article about how those charts work so you can better understand how they might affect trading. This chart of CTA exposure from Goldman Sachs Prime Desk shows that if they have to sell their exposure here, they've got somewhere between about $150 billion worth of exposure. So these CTAs are very long the market again. They've gotten a little bit ahead of themselves in the sense that, yes, we've had some good momentum, but their positioning is lopsided again. There's not a lot of room for buying. There's a lot more room for selling. So if we do see upside, there's about $25 billion worth of buying. If we do see downside, depending on the severity of it, there's about $100 to $150 billion worth of potential selling in the near term and more over the longer term. I would keep that in mind. CTAs obviously don't run the market, but when they start selling pretty indiscriminately, particularly after options expiration, it can be a big deal. So remember, after options expiration, those same supportive Vanna flows are pretty well out of town. Charm tends to be less pronounced as well. And that does tend to create more opportunity for bears to push prices meaningfully lower and for bulls to push prices meaningfully higher as well, but mostly the bear side, because the put skew in the S&P causes most of those passive flows to be more bidding the market. That is to say, when there's delta decay, when vol is falling, you've got dealers buying back up that stock of short interest that they have because they're selling puts and they have to make sure they're delta hedging. They have to make sure whatever it is that they're selling, that they can pay that contract. And to be delta neutral, that means buying the equivalent amount of S&P futures, or if if they're selling calls or if they're selling puts, they have to be selling the equivalent amount of S&P futures. So to be clear, for a dealer to be delta neutral, they're selling contracts, right? Those contracts, those calls give the optionality of, if you're right and you're in the money, or at least you make more money on the contract, that the dealer has to pay you the difference. And the way they accomplish that is by dynamically hedging the delta of their book by buying S&P futures commensurate with the size of the SPX delta that you've bought from them. On the other side, when you're selling, essentially, like when you're buying puts and you're protecting against downside or you're making a directional bet, then the dealers have to sell to hedge that delta as well. And so this all has a big impact on the market because S&P futures, the S&P 500 index, those futures move $1 trillion a day. 50% of that is 0 DTE, and that's notional, right? So that's $1 trillion of notional changing hands. The options market versus every other instrument is 70% of the notional that changes hands every day as well. These are values that have steadily increased over time, and now there's over $1 trillion worth of S&P options that trade every day as well, with, again, about half of that on the 0DTE side. So you can see there's so much notional value exchanging hands every single day that, and especially from the option side, that it can have a very big impact on the market. And that's another area where we start to see some changes as we've gone over the years and we've had more expiration dates. That's allowed there to be more 0DTE impact. That's allowed there to be greater speculation in those options. And thus, they've had a much bigger effect on price discovery. I wouldn't say it's the only area of the market to watch. That's why we look at this through various lenses, but it's a very important area to be aware of. And speaking of options, we can see that same area of enormous interest above us. This wall of calls at 4150 and then an even bigger one at 4200. These are levels that are likely to be extreme resistance, particularly 4200. I think if this move has an ultimate cap, 4200 is the most likely one for now. Now, as we get through options expiration, we may see positioning change. And as price moves, positioning is likely to change as well. But for now, I would keep a very close eye above us at 4150 and 4200. And below us, I would be keeping an eye on 4100, 4050, and 4000. These are levels that I think are going to be very, very important as we navigate the rest of this month and even the month ahead. And we can see on the chart here, SPX 4150, how it's an area where there's been a lot of interaction. This is an area where people have liked to transact a lot over the last year. So it's not too surprising that we're revisiting it. It makes a lot of sense. Now, whether we break above it or not is a whole matter that is a different discussion. That's something we'll find out. But I believe that we're at least closer to the end of this counter trend rally. I still do maintain that this is a bear market environment, that we've had a great counter trend rally since October based a lot on some of the offsides positioning, extreme negative sentiment we've seen, and liquidity coming back in the market. But I believe a lot of those factors are, we're seeing much more bullishness as we get into earnings season here. And it's likely that this could be a pretty difficult earnings season. And a lot of this earnings season is going to happen after options expiration, when we're in that window for potential additional weakness in the market. So I would just keep that in mind. And then after, we really have a lot of earnings season, we also have the Fed on May 3rd, which likely is going to hike by 25 and leave the window open for another 25. So just keep that all in mind. Risks are growing. We've had a great rally, even from the lows that we've seen in March. So risk is something we balance carefully. As Horst has pointed out, we've been in the same range for basically about a year. So there's no reason that we're necessarily going to make a major change from that sort of range-bound trade that we've been in. I think that that's something to keep in mind before we get too bullish or too bearish. And then eventually this breaks one way or the other. And as price-driven traders, we need to be mindful of that based on a day trading and swing trading basis, that whichever way price really materially moves when we break out of this range, ultimately above 4,300 or below 3,500, that's going to decide the next leg of the market. And one thing that's interesting, going back to gold, I mentioned it a little bit earlier, but I do think it's something that's worth watching. And I see this as someone who believes that gold has a role in a portfolio, particularly when you're buying it during times that are calm and it's much cheaper. There were folks that were buying it in the 1600s, for example, recently, and that was an advantageous entry point. But I think it's important to be careful here. I mentioned this on the last midweek update. I said, I feel like you've got to be cautious of gold. I didn't outright call on shorting it, but I've been expressing some caution about gold for a little bit because I've been trading the gold market since 2006. And one of the things that I see in this market is you have cycles of extreme bullishness. And that extreme bullishness is usually hinged on something like there's going to be the end of the dollar, or there's going to be a thermonuclear war, or there's going to be some kind of crash in the financial system. And all of those fears are now being bantered about. There's fears of the banking system failing. There's fears of the dollar collapsing. There's fears of, some kind of new world war. And I'm not trying to dismiss the fears. I think some of them are completely over the top, but I think that it is important to realize that this is the environment that gold thrives, an environment of uncertainty, of fear, and people panicking into it. And you can kind of see that in the chart. You can see some of that very excited price action where it's just going straight vertical. This is the time to be cautious. It doesn't mean gold can't zoom higher, but it does mean there's a lot more downside risk because everyone is talking about it. Everyone is buying it. Jewelry sales are up. ETF sales are up. Gold stock and ETFs and funds are seeing inflows. I would just be a little bit cautious here. It doesn't mean that ultimately it can't move higher. It typically does during a recession in particular. But I do think in the near term, particularly after some of the selling we saw to close last week, it's important to be careful of the shiny stuff. Now, on this chart here, we have gold versus the 10-year real yield inverted. This has been a reasonably good leading indicator for gold. The divergence here is an extreme. So this is something that would tell me that, if gold does start to catch a sell, there could be reasonable downside here. But that's not all. We also see that there's a pretty big divergence between the dollar and gold. And that also suggests to me that there's some cause for concern because gold has some room to catch down. This divergence sometimes is built on the back of too much extreme optimism when gold is this much higher in relative terms than the dollar. After all, gold is priced in dollars. So I would keep an eye on this as well. And I would say that this suggests that gold is getting just a little bit ahead of itself. These charts, by the way, are from Refinitiv. They are definitely quite cool. And then we also have upcoming a lot of key events next week in the economy. We've got the New York Empire State Manufacturing Index, the National Association of Home Builders Housing Market Index, builders permits, the preliminary reading, housing starts, the Mortgage Banker Association's 30-year mortgage rates, jobless claims, Philadelphia Manufacturing Index, existing home sales, S&P Global PMI data, and a whole cadre of Fed speakers, because I know you guys love Fed speakers. You can't get enough of them. They know it. They've got to come out there and they're going to make sure that everyone can get their share, if not more than they ever wanted. So that's going to be fun. But in more seriousness, the amount of information that we get about housing next week, if you're interested in that part of the market, is very important. I would be looking at the housing starts, the building permits, the NAHB Housing Market Index, and mortgage rates, as well as existing home sales to get a much better idea as to how the housing market is doing. For manufacturing, the New York and Philadelphia manufacturing indexes are very interesting. We've also got a whole bunch of S&P Global PMI data on Friday, the Global Manufacturing PMI, Services PMI, and Composite PMI, all that next week. So it's not a heavy hitter for macro, but it's still a pretty interesting week. There's still enough data that there's something for everything in all of this. And of course, we get initial jobless claims on Thursday, which is going to give us a bit of a sense as to whether this trend of what is higher than what we've recently seen of initial claims continues. I believe it will. I believe we're starting to see some weakness in the labor market. It'll take a little while for it to pass through, and then eventually it'll accelerate. But I do believe we're starting to see that weakness, which is good news for inflation. It'll start to subdue it, but it's bad news for the economy and eventually for earnings. $139 billion in Treasury bill auctions next week. This is kind of a nothing burger because there's not a lot going on here. These bills will be well subscribed. People will buy them. It's much more interesting to me when we have notes and bonds. And earnings next week, we've got a whole cadre of everything next week. We've got a bunch of banks reporting on Monday. Of course, we've also got Charles Schwab. Everyone's been keeping a close eye on this company. There's been a lot of rumors that they're going to fail, that they have all these problems. I'm just going to go out on a limb and say Charles Schwab is an American institution. It holds $7 trillion of retirement and investment assets. If it were to fail, it would be devastating to the global financial system, and it would really erode the trust of a lot of Americans in the stock market and investing in general. I don't think it's going to fail. I don't think the government will let it fail, but I also don't think that their problems are bad enough that they would fail. Aisha's done a great job covering this. She's talked about their balance sheet and the kind of situation they're in on the Discord, as well as in some of the content that we've recently produced for MacroVisor, where there's a free earnings season coverage that you can check out that's going to be posted on the website shortly. And that's going to be a comprehensive, it's about an hour long coverage of what's going on next week. So I can't hope to replicate all that depth in what I'm going to cover in this slide. If you're interested, head over to macrovisor.com, and it's free for next week to check out the earnings coverage that we are providing. And we're running a 50% off sale, so you can check that out and get 50% off your first year until April 20th by visiting macrovisor.com. Next week, though, is really lots and lots and lots of banks. We've also got material stocks. We've got some heavy hitters in tech and growth like Netflix and Tesla, ASML. We have Taiwan Semiconductor, and we've got AT&T, which is a really big telecom cable pure play. They've moved out of media, making them much more interesting and streamlined. I also think it's interesting that we have some defensives. We have Procter & Gamble. We have Johnson & Johnson. We've got some of the big banks like Bank of America. M&T Bank is an interesting regional. We've got Ally Financial. Just sort of a little bit of everything for everyone. These are just the highlights. These are just the most anticipated earnings. I don't think that this even begins to cover the depth. And really about 80% of the S&P is going to report by the time we hit early May. So it's just so much earnings coming up. You've got the big investment banks like Goldman and Morgan Stanley. You've got legacy technology companies like IBM, which it surprises everyone every day that they still exist. And it's just a very jam-packed week. It's got even credit card companies like Discover, American Express, Synchrony. We'll have a lot of data to digest after next week. It's going to be a very interesting week, and you've got to imagine some of these are probably not going to go so well. Others will probably go better than expected. It's anyone's guess as to which is which, but once we know that and we start to see patterns in certain industries or with certain types of talk about customers and business trends and what's going on in the economy, it gives us a better sense as to what we can expect from other companies and from the economy as a whole. And that's really helpful. Reading the transcripts or listening to the conference calls is some of the best intelligence you can get in the market, and it's completely free. So that's everything I've got for this week's episode of Navigating the Markets. I hope you enjoyed it. I enjoyed making it, and we're going to be back with this content coming up next weekend. And remember, throughout earnings season, don't try to be a hero and play these crazy earnings plays. It's not worth it. Vol Crush can kill you in options. On the other side of it, it's really dangerous to play any side of this stuff thinking with confidence that you know what's going to happen. You can get lucky, but often is the case, the market will eventually humble you. It's more like playing a slot machine than doing anything tactical. So hope everyone has a great trading week ahead. I apologize, this video is coming out a little later than I usually do it. It's been a bit of a jam-packed weekend here, but I hope you all enjoy it, and I look forward to talking to you all on the website and the Discord.